Hello, in this presentation we will compare QuickBooks Online versus QuickBooks Desktop. Hello, in this presentation we're going to enter a reversing entry related to accounts receivable within QuickBooks Online. We will have a comprehensive QuickBooks Online course soon, if not available yet. We also have a comprehensive Excel course which complements the QuickBooks courses, and a QuickBooks Pro desktop version course you can find at the link below. Here we are in the QuickBooks Online dashboard. We will be continuing with the Get Great Guitars problem. We're working on reversing entries here, and the entries that we are reversing are some of the adjusting entries, those entries made at the end of the time period, usually a month or a year, in our case, the month of February. We're reversing those in order to separate the two functions, one being the normal day-to-day processing function to move logistically well as compared to the month-end process to make the financial statements in accordance with the accrual principle as closely as possible. To see those concepts, let's first take a look at our reports here on the left side. We're going to first go to the balance sheet report, and we're going to take the report for our range of dates, which is 01/01/21 to 02/28/21. That's January 1st, 2021 to February 28th, 2021, and run that report. So here's the report that we have. Now, remember our goal, here's the dates up here again. Remember the goal that we have here is to have everything correct as of the cutoff date. So we want everything correct as of February 28th. That doesn't mean we're not concerned about any other date. It just means that that's the date we're making the financial statements as of, and therefore we want to make everything completely accrual-based correct as of that date. Some things logistically work well to not exactly be on an accrual basis all the time. One of those things might be our billing process. So our billing process, we might say, hey, we got to bill every 2 weeks or so because we have to count up all the bills and all the hours and then bill somebody. And the time it takes to do that might mean that our normal processing cycle may be 2 weeks later after we actually do the work. The problem with that is that from an accrual standpoint is that QuickBooks recognizes revenue when we create the invoice. And if we created the invoice, in our case, in March, when the work was actually done in February, QuickBooks would record the revenue in March when we really need it in there in February. We need the increase in the receivable in February. Even though the invoice didn't go out, we earned the revenue and people owe us that money at that point in time. And the other side is the revenue side. We earned it. Now, in our case, we ship guitars, so we would typically look at the point in time that the guitar was shipped to the owner, and if that happened in February, even if for whatever reason the invoice went out in March, we should really have that recorded in February. So that's the adjusting process. So in the adjusting process, we pulled that information back here. So if we take a look at the accounts receivable and scroll down, we will have an adjusting entry here for, I believe this is the one. This is for an invoice that we recorded. We recorded a journal entry, which is in essence an invoice journal entry. So if we make this date go out a bit, I'm going to hit the plus arrow a few times, go to March. Let's make it 10th or 11th and run that report. Then we'll see the full story here is that this invoice actually happened in March. So this invoice is in March. And the story is that it should have been in February because that's when the work was done, even though the invoice didn't go out until March. So if we select this item, this is our journal entry, that is in essence the journal entry that will be pulling this information back, meaning accounts receivable is going to go up. Just a normal, this is the journal entry for a normal type of transaction for an invoice with inventory. Accounts receivable is going up, sales is going up, the fact that we owe sales tax is going up, cost of goods sold is going up, and inventory is going down. This is actually a pretty complex journal entry, even though it's just an invoice. The invoice is something that everybody makes. Any kind of sales clerk makes the invoice. But what actually is happening when you create the invoice is a little complex, and to set up what is happening and correct it if there's something wrong, and do these adjusting entries really gives a better idea of what an invoice is doing. So that's going to be this side of it. So I'm going to close this back out. And so you can see that this pulls it back into the correct time period in that we pull it back to the month of February, but then we have this problem in that it's in there twice. So here it is here, and then we have it here by March. So it's fine for our cutoff date as of the end of February, but by the time we get to March, now we have the invoice in there and our adjusting entry. And so we have this conflict between making it right for an accrual basis as of the cutoff date and the logistical basis. We might have had a good reason for whatever entering the invoice a little bit later. So now we got to do something to fix that, and what we'll do is just reverse the entry. So we're going to do another entry as of the 1st of March, not the 3rd. We're not going to try to make it exact in the point in time. That means there's going to be 3 days where the financials are wrong by this invoice. We're going to accept that just as a logistical reality. We're just going to say, hey, the benefits of just making it all the reversing entries as of the 1st are greater than trying to make every day correct. And so that's how we're going to work this. Let's take a look at one more side of this. I won't take a look at every aspect of this adjusting journal entry, but we want to look at the profit and loss side. So I'm going to go to the reports, and we're going to go to the profit and loss. And within the profit and loss, we're going to type in the date of 02/02/28 to, whoop, yeah, no, that's not right. That's not right. 02/02/21. 02/01/21, February 1st, 2021. 02/28/21, February 28th, 2021, and run that report. Okay, so here we have our cutoff time period again. We're going to run just looking at this month, and obviously our cutoff date is the 28th once again. This is a timing statement, meaning it needs a beginning and an end. And we're talking about something of a sales item. So sales, because we had we sold inventory. So we're going to take a look at this 2,500. And if we scroll back once again, we see the 500 for this journal entry. If we select that item, that's us pulling in. This is that same journal entry, increasing the sales amount as we did accounts receivable. We'd see the same thing in cost of goods sold and inventory. And if we close this back out, if we want to see the full story, I'm going to make this a little bit in March again. Go towards March, go for a little bit in March. And then we're going to say March 9th and run that report. And then if we scroll back down, we'll see more of the whole story here, where we had the 500 made us correct as of the cutoff date, which is the 28th. Maybe I should make one of these cells a little smaller so we stop going back and forth like that. So that is as of the 28th. As of the 3rd, then we have the actual invoice. So we're correct as of the end of the month, but we're not correct for a couple days. On the 3rd. What we're going to do to fix that is have an adjusting entry on the 1st of the new month. All right, let's go back to the profit and loss, and let's check one more thing out, and that's going to be the cost of goods sold account. And that's going to be the expense related to this journal entry that we're going to be working with. And here it is again. Note it's $400. So I'm going to take a look at that journal entry, same one. This is the one we're going to reverse. So we've seen it a few different times now. This is the one that we're going to reverse. Now, just recording this journal entry is a little bit complex. To think about how to reverse it, it's easiest just to look at this one and then do the exact opposite, meaning, we increased the accounts receivable with a debit, so we're going to credit it. We increased sales with a credit, so we're going to debit it. We increased the tax with a credit, so we're going to debit it. Cost of goods sold has a debit, so we're going to credit, and inventory went down with a credit, so we're going to debit it. We're going to do the opposite for the whole thing. Now, if you see this in a book problem, they will probably adjust the ordering of the debits and credits in the reversing process so that the debits are always on top and the credits are on bottom. But it's probably easier just to mirror this exactly. So however you thought to put this here, just do the exact opposite, same ordering of accounts, but reverse the debits and credits. So that's what we will do now. So I'm going to close this back out. And note, we're not going to use a register because this is a complex journal entry, and the register may be able to handle this, but it's a little too complex to try to use the register. The journal entries are really the best way to go. Knowing you kind of have to know debits and credits to really do a transaction like this properly, or at least as easily as possible and properly. So we're going to go to the journal entry. We're going to go to the plus tab. We're going to go down here to journal entry, and we're going to change the dates here to the first day of the next month, which is 03/01/21. All of our reversing journal entries will be as of the first day of the next month. And if you can just memorize that last, or just think about that last journal entry we looked at, we're just reversing that. The first thing that happens in an invoice, we think of an invoice's increase in receivables. So we're going to decrease receivables with a credit. So we're going to type in accounts receivable. Here's accounts receivable. And it's going to be credited for the cost, which was $500, plus the sales tax of $25, or $525. And I'm going to call this a reversing entry. And somehow the caps lock went on. All right, we fixed the caps lock problem, and now we're going to be on the name. Now we have to have a name with accounts receivable because the QuickBooks will not let us record to accounts receivable typically, because it'll say, hey, you know, I need to make up a subsidiary ledger by customer, and I can't do that unless you have a name here. And that's going to be a customer name typically, and I think it was string music that this invoice was for, I hope. So that will be the one that we will select. Actually, that's not correct. It was Sam the Guitar Man. Sam the Guitar Man. So once again, we got accounts receivables, the account, and it's going to be a credit to $525. It's a reversing entry for Sam the Guitar Man. All right, then the next side, we typically think of, or I typically think of, the other side going to the sales or revenue account. So the sales typically goes up with a credit because it's a credit balance account. So we're going to do the opposite and debit it to reverse it. So we're going to call it sales of product. We're going to debit it for the invoice price, which is $500. So it's $500. It's going to be a reversing entry. The difference then is going to be the sales tax. Sales tax is a liability, typically going up with a credit. So we're going to do the opposite, and we're going to debit it. Now, ours is going to go to the California State Board, because that's what QuickBooks called the account, California State Board of Equalization. And we're going to debit that for $25. It's going to be a reversing entry. And then we have the other side of it, meaning inventory is going to go down and the related cost of goods sold. So that's going to be cost of goods sold has a debit normally. So we're going to do the opposite and credit it. So we're going to type in cost of goods sold. And that's going to be cost of goods sold. It's going to be a credit for $400. That's the cost, not the sales price. And then the other side is the inventory, which would typically be going down with a credit. We're going to do the opposite and debit it. So the last piece will be the inventory. So we're going to call it inventory. It's an asset account. Asset accounts, it would have been going down with a credit. We're going to debit it. So here's the full journal entry. Remember, this is the reversing of an invoice, so that we don't see this too often, but if you can get this reversing of an invoice, you really are having a pretty good understanding of what an invoice is and how it's recorded. So an invoice typically will increase accounts receivable with a debit, and we're doing the opposite and credit it. An invoice will typically increase sales or revenue or income with a credit. We're going to do the opposite and debit it. An invoice will typically increase the payable we have, which is a credit, and we're going to do the opposite and debit it. An invoice will typically increase the cost of goods sold, the expense for the cost, not the sales price, with a debit. So we're going to do the opposite and credit it. And an invoice will typically decrease the inventory for the inventory we sold at cost with a credit. So we're going to do the opposite and debit it. So we'll save this and see if it does. Now remember, the date here somehow changed. It should have been 03/01/21. So it's the first day of the next month. So we're going to save this and see if it does what we believe it should be doing. So we're going to save this and see what happens. We will close this out. Going to go back to our financial statements, back to the reports here on the left side. We're going to run the balance sheet, and we'll change our dates once again to 01/01/21 to 02/28/21 and run that report. So here is our report. If we take a look at one of the accounts affected, such as the accounts receivable account, we will then see the activity. And remember that we saw that activity down here related to our adjusting entry, the 525. I'm going to try to make this a little bit smaller if I can grab that. It's going to be the 525, and we then are going to adjust this as of the first day of the next month. So what we're going to do is we pull this in here on 228 is scroll back up, and we're going to increase the date once again a few times to, let's say, 3/8, and run that report. Scrolling back down, then we'll see that we've got the 525 happening up here on 228, and then we're reversing it as of 3/1, so it could then be recorded again with the actual invoice. So let's talk about that one more time. Remember that it was originally recorded here. This is when it first happened in time, in March, and it should have been in February. So to make that work, we made an adjusting entry to pull it back into February, but now it would be in there 2 times by March 3rd, and therefore we reversed it right after we made the financial statements as of the end of the month, February. We just reversed it right here. We didn't do it on the 3rd exactly. We could have tried to do that, but we'd rather just make all reversing entries as of the same day, the first day of the next month. We reversed it here, noting that it will be wrong for 3 days. That's okay. And then we're going to have it appear here again on the 3rd, and that's when the actual invoice is recorded. So I'm going to scroll back up, and we'll see the same format in the other accounts that'll be affected. I'm just going to take a look at the inventory account. So we're back here on the balance sheet. We'll take a look at the inventory account and see the same activities. So if we go into the inventory, now I've shortened some columns a little bit. It's a little finicky sometimes with the QuickBooks Online, but just you can adjust those and go back in and out to fix those as you please. And then we have the journal entry down here. So remember, we pulled this in and decreasing the inventory by that 400. That's our adjusting entry. And now if we increase the date a bit to March, that should do it, March 7th, and run that report, and then scroll back down, then we'll see the full activity. We pulled it back into the end of the month, March 28th, and then the actual invoice happened on the 3rd. So if we had that in there twice, we'd have these 2 negatives. Inventory would be going down 2 times. And that's not quite correct. What we should be doing is, what we're going to do to fix that is reverse the inventory right here with this 400. So it made it correct. We pulled the decrease in the inventory to the correct month. Then we reversed it as of the first day of the next month. And then the actual invoice happened. Let's see that same thing on the income statement side. I'm going to go back to our report. Then we're going to go to the accounting down here. I'm sorry, we're going to go to reports. Reports on the left. And we're going to go to the profit and loss this time. And we'll see the same thing with the sales account and the cost of goods sold. So we're going to make this as of the month of February 02/01/21/02/28/21, February 1st, 2021 to February 28th, 2021, and run that report. So if we scroll back down, we see the sales products. That's the one we want. So we're going to select that, 2,500. And once again, I went in here and adjusted the columns a bit. So if we scroll down, we see the 500 here. That's the revenue related to the adjusting journal entry that we pulled in to this month. We did that with a journal entry, not an invoice, because the invoice would happen in March. If we increase the date a little bit to the next time period, that should do it, the 5th, run that report, and we scroll down, then we'll see that we pulled it back into March with this journal entry. The actual invoice happened on March 3rd. So remember the order of when this happened and then the dating order. It happened in time. This actually happened first, but it didn't happen until March 3rd. But the inventory was actually delivered sometime in February. Therefore, we, at a later point in time, entered this journal entry as of the end of February so that we can then record this revenue in February. And then we reversed it as of the first day of the next month so that we can keep this original invoice that we originally entered in March 3rd. So that's going to be the process there. We'll see that one more time in one more account, and then we'll stop this. The next is going to be the cost of goods sold. So we're back on the profit and loss report. We're looking at the cost of goods sold, the 2,000, selecting the cost of goods sold. We see the 400, same thing. This is the 400, increasing the expense of cost of goods sold, decreasing net income. We made the sale, and therefore the related expense should have happened in February, even though the invoice didn't go out until March. and therefore we need to bring this back into February. And if we increase the date just a little bit, once again, to like March 5th or so, and run that report, scrolling back down, we'll then see that this one, remember, happened first in time. It's increasing the cost of goods sold, decreasing the net income, but the date is later, of course, because even though it happened first in chronological order when we did it, the date was after the actual inventory was delivered, and therefore we needed to pull it back into February. So we did the adjusting entry to pull it into February and be correct as of this financial statement date, and then we reversed it as of the first day after the financial statement date, so that this invoice that we had entered originally will now be the only thing affecting the financial statements as of that point in time. So it's just a timing difference that we're dealing with here, and we're trying to differentiate between just getting things perfectly correct as of the financial statement and just doing things logistically as they're done for the normal accounting cycle. Hello, in this presentation we will enter a reversing entry for the adjusting entry of accounts receivable within QuickBooks Pro 2018. If you've been continuing with us, we will be continuing with the Get Great Guitars problem. If not, that's okay. We're going to be talking about reversing an adjusting entry that was made at the end of the time period, the purpose of the adjusting entry, and the reasoning of the reversing process, as well as the function and how do we do the reversing process. If you have the backup file to this point, you can restore that by going to the File and Restore. We currently have the Open Windows tab open, which you can go to at View and Open Window List, the only open window being the Home tab at this time. If you want to open the Home tab, if it's not open at this point, go to the Company and Home page to open the Home tab. We're going to talk about a reversing entry for accounts receivable. And first we have to look at, why did we put that accounts receivable journal entry in there? What's the point of reversing it? And remember, we looked at this last time. We have a prior presentation of the adjusting entry for an invoice. The issue is that an invoice would have been entered after the cutoff date, and therefore the revenue would have been entered after the cutoff date, for which the work was actually done before the cutoff date, and therefore the revenue that QuickBooks has generated for the invoice was posted after the date in which we need it to be posted in. In other words, in this case, it was posted in March. That's when the invoice was generated, and we needed to pull that income back into February in accordance with the revenue recognition principle. In order to do that, we reversed the whole invoice. We didn't want to change the invoice. We didn't want to change the dates on it because that's really not proper accounting. Oftentimes we can't do that. There might be other things that are connected to the invoice, and really we would like to have a paper trail in which the invoice is in there as its original format, and make any adjustments that we need to at a later point. And so we made a reversing entry, basically making the journal entry related to a creation of an invoice into the adjusting process as of the end of the time period. Now we're going to reverse that. So let's take a look at what happened here. We're going to go to the reports up top. We're going to go to Company and Financial, and we're going to scroll down to the Balance Sheet Standard. We're going to change the dates. We're going to go to Customize Reports up top, and the dates are going to be 01/01/212 02/28/21, January 1st, 2021 to February 28th, 2021. And then we're going to scroll down to what happens with this invoice. So if we look at accounts receivable, we can see part of this transaction. And if we scroll down, we see that this is the invoice that we created. So this is not, it's actually not an invoice. Note that what we did is create a general journal that will mirror what would happen in the invoice actually having been created in the following month. So if we double click on this item, this is how we generated it. We didn't do a journal entry, we used a register in order to generate this invoice. If we close this back out, and if we go to the profit and loss by going to the reports up top, Company and Financial, profit and loss, changing the dates to 010121 to 022821. We're going to look at the merchandise sales and we'll see this same information. So we'll double click on the merchandise sales and there's that general journal again recording the revenue here in the sales item. So I'm going to close this back out. The other side of it is in the cost of goods sold here. Double clicking on that, here's the cost of that inventory, 400. If we double click on that, that's another registered journal entry that we put here. And closing this back out, we're back here. So in essence, when we create an invoice, we know that accounts receivable is going up. We know that sales is going up here. We know that cost of goods sold went up. And we know that inventory is going down and taxes payable is going up. So all that is happening when we created the invoice, and we adjusted that invoice back into this time period. Now let's take a look at the next month, the month of March. We're going to say that that is going to be 030121 to 033121. And so March 1st, 2021 to March 31st, 2021. We have this invoice here. This is the only thing we have so far, and this is the invoice that we entered in March that we had to then pull back to February because at the point the invoice was generated was a point after the date in which the work was actually done, meaning the work was done in February and we wrote the invoice in March, QuickBooks recording the inventory or the revenue in March. So if we double click on this, here is the actual invoice that we basically recreated with general journal entries in February. And what happened when we did that then, we made February correct, but as of this point in time then, we're going to close this back out, close this back out. As of this point in time when this was recorded, now it's been recorded twice, meaning this $500 of revenue was recorded in February, the correct time period, and now it's recorded again in March. So what we need to do is have a reversing entry, and we're going to reverse what we did in order to put that journal entry into February. You'll note that this invoice was in there as of something like March 5th, I believe it was. The reversing entries, however, are not going to be reversed as of the date of this invoice that it's reversing. Typically, we're going to put them all in there as of the first day following the month that the adjusting entry was made. Adjusting entry made as of the end of February. A reversing entry then made the first day after, or March 1st. So there's going to be a couple days, in other words, between that point in time, March 1st, and the point in time that this invoice was created, where the financials are kind of wrong on an accrual basis, where that isn't reported. And that's okay because we made it correct as of the financial statement date, and then it's going to be correct as of the end of the month. It will be correct as of the date that this invoice was created. So we're going to reverse what we did in terms of an adjusting entry at the end of 12/31 as of March 1st of the following month. So let's do that. I'm going to change the dates back. I'm going to go to say back to 02. Let's make it go back to 010121 to 022821. Back to the prior time frame. Now there's two sides of this entry that we have to reverse. Typically, we would reverse these entries by doing a journal entry, by going to the company and going down to make journal entry. But in an attempt not to use debits and credits, we are using the registers in order to do this. So we're going to do this with registers looking at plus and minuses rather than looking at debits and credits. It's going to be the same type of concept, however. So we have the sales. We know that part of the reversing process was that we had accounts receivable go up, we had sales go up, and the other side of that is the payable for the sales tax payable. If we go back to the balance sheet, that's actually the register that's it's easiest for us to use. Is going to be this sales tax payable account. We're going to go into the sales tax payable and basically record that half of the journal entry. So in order to do that, we're going to go to the banking up top. We're going to go to use register. And we're going to look for that sales tax payable. So if I scroll down, we're looking for the register of the sales tax payable. There it is. And we're going to say OK. we can now see what has happened before. So this is the actual invoice that we made this reversing entry for. So this entry happened in March. We made this adjusting entry, this general journal entry, as of the end of February in order to reverse this. And now we're reversing this entry right here. So this is going to be as of March 1st, and we're basically going to do the reverse of this item here. So if we look at this item, we see that we had a billed item, so we're going to be in the paid section. And then we have this split here. So if we want to see that split, sometimes QuickBooks will let us use the split icon and show us this split there. So there's the split. So we want to do the reverse of this, meaning we're going to go into the paid 25, we're going to go into merchandise sales, have a positive 500, and then accounts receivable have a negative 525. So let's close that back up. We're going to go into the paid section as of March 1st. We want to be on the paid side for 25. And then we're going to select the split. Instead of just one account, we need two accounts and see what that split will be. One account is going to be the sales account for merchandise sales. The amount of merchandise sales was 500. We're going to put a negative 500, which in essence is the opposite of what we did here because we're reversing this journal entry. The other side is going to be accounts receivable, and we're going to put a positive 525 in essence because that's reversing this transaction up here. It's the opposite of what we did here. And then we're going to choose the customer, which will be Sam the Guitar Man. We got to have a customer or QuickBooks will not let us post anything to the accounts receivable account. Now this is one of those areas where this ledger, putting it in this ledger is almost as difficult as, or it is surely more difficult if we understand debits and credits as using journal entries. However, if we don't understand debits and credits, we can use the register and possibly use a little bit of trial and error in order to work with the register. Typically the registers work best when there's only two accounts involved in a transaction, and when that's the case, we can basically say we're going to do whatever we need to do to one side of the transaction and then just point to another account, and QuickBooks can in essence debit and credit the correct accounts. In this case there's three accounts involved. That makes it a little bit more difficult. But we know what's happening in terms of, we know that sales is going up on our invoice, or sales is being affected on our invoice. We are reversing sales of the 500. We know that we're reversing the accounts receivable of 525, the sales plus the sales tax. And we know that the accounts payable is affected by the amount of, not the accounts payable, the sales tax payable, by the amount of the sales tax. So let's go ahead and see if it lets us record this. If we're not in balance, it wouldn't let us record this, and we can use some trial and error to try to figure out which way these things are going using the registers. So we're going to say record this. We needed to add a vendor here, so I added the vendor of New York State sales tax for that 25 and say record. There we have that information. If we go back up to the balance sheet now, we are going to look at the first date in March. So I'm going to change this to 03/31/21, first day in March, and we have the sales tax payable. If we double click on the sales tax payable, I'm going to change the from range to 01/01/21 and tab through this. We have our adjusting entry here. We have the reversing of the adjusting entry in the first day of the next month, and then we have recorded again, this being the actual invoice that was recorded, or in reverse, this is the original invoice that was recorded in the wrong date in March, which we pulled back to February in order to adjust for it, and then we reversed it in the following month so that these two will match out and not cause a problem. So we're going to close that back out. We should see the same kind of effect in the accounts receivable. If we scroll up, accounts receivable, double clicking on the accounts receivable, changing the beginning date to 01/01/21, refreshing this. Once again, we see our adjusting entry. We see it's being reversed as of the first day of the next month. And then we see the actual invoice, or in other words, the invoice was originally created in the wrong month. We recreated it in February. And then we reversed it the first day of the next month in order to cancel these two out and not have this entered two times. So we're going to close this back out again. We're going to go to the profit and loss. And if we take a look at the profit and loss, double clicking on the merchandising sales, we have this is the current period, so the period in which we made the financial statements as of, and we have the 500 in the New York State sales tax there. If we look at the next period, 03 3121, then we can see the full items here. So here it is in terms of our adjusting entry. Here's us reversing it in March, and here's the actual invoice. So the same kind of pattern happening, or in other words, here it is recorded in the wrong month. Here it is us fixing it with an adjusting entry. Here's our reversal of that adjusting entry so that this is not entered 2 times. If we close that back out, now we're going to do the same thing for the second half of the transaction, that being the decrease or the increase in cost of goods sold, and the other side of that is the inventory going down. So if we double click on this item, we see this 400 right there. That's our adjusting entry. This is what we're going to reverse. I'm going to close this back out, and I'm going to go back into that register, back into a register from the balance sheet, the other side of this being the inventory. So we're going to try going to the inventory register to reverse this. So in order to do that, we're going to go to the banking. We're going to go to use register, and we're going to scroll down to the register, the inventory asset register, clicking on that. And here are our items. So here is our adjusting entry as of the end of March or February. Here's the actual invoice, and here is us where we're going to just fix this. So we're going to reverse this back out. So this journal entry, it only has two accounts, so it should be easier this time than the last one. And note what we did here. We had the decrease side. So to reverse it, we're just going to go to the increase side here. And the other account here was cost of goods sold. We're going to have the same other account, cost of goods sold. So we're just reversing this item out. Then we will record this and see if it does what we hope it should do. So we will record this. Going to close this back out. And then if we go through our balance sheet, now if we look at our inventory, here's our inventory, double clicking on that. If we change the date range from 01/01/21 to the end of the month, here's our 3 items again. Here's our adjusting entry as of the end of the month. Here's our reversing of the adjusting entry as of the first day of the next month. And here's the actual invoice that was created in the incorrect month. If we close this out and go to the other side of this on the profit and loss, and we take a look at the cost of goods sold and change the dates from 01/01/21 to 03/31/21, we see that same activity here. Here's our journal entry, bringing it back into the month it needs to be in. Here's the error that happened, or the invoice that was created in the wrong month, and then here's us doing our reversing entry. In other words, here it is in the wrong month, it was entered in the wrong month, right transaction, wrong month. Here's us pulling it back into the correct month, and then here's us reversing it as of the first day of the next month. So that would complete the reversing process for a invoice. And if you can understand this reversing process and this entry process, then you're doing a really good job of understanding what an invoice is actually doing in terms of recording the invoice. Because by understanding this process, you first have to know what the invoice is doing and know all the accounts that are affected in order for you to then enter the transaction to mimic what the invoice is doing without an actual invoice, but through journal entries and or through a register format, as we have done in the reversing entry process. And then you actually have to reverse that reversing entry, doing kind of the opposite of what an invoice does as of the next time period. So if you can kind of understand what's going on here, you're really going to get a good idea of what's going on when you record an invoice.